Joining me on the show is Feroze Azeez to make sense of markets as of this morning. Feroze, thank you very much for taking time out. Just as of yesterday, we were thinking markets likely entering the consolidation phase, but they seem to be rebounding as of this morning.
Yes, Shweta, good morning. Like you rightly said, markets were going down. They went down significantly, about 250 points on Nifty yesterday. When you look at how this whole thing has happened, is that if you look at the net short data of FIIs yesterday, what has happened is they have almost about shorts have gone up from almost about 57% to 63%. That's one of the sharpest short build-ups of FIIs in a single day for just a 250-point move downwards. So yesterday's fall was derivative-led because there was a Sensex expiry yesterday. So the rebound was natural. Anytime you see a derivative-led fall or a rise, the next day reverses that position, at least marginally. So this is the hypothesis which I've tested over the years. Cash market-led rallies build on it, or cash market corrections build on it. But derivative market moves have an opposite direction in the subsequent 1 or 2 days, or at least consolidative moves over the next subsequent days. This one study, which can help most traders, is something is approved again marginally with, of course, 1-2 days data is not what gives you that hypothesis test with significance levels of 90%. But this is good 5-7 years of trading data, at least about 1,000 trading days is what I've analyzed.
In fact, you mentioned FIIs. In fact, FIIs offloaded equities worth 10,000 crore rupees just yesterday. What is leading to the sellout?
See, there are some block deals as well in that, where there is a change of hands of promoter equity. So I personally think that those are not freely traded shares. So that's why I would not consider. So I would bifurcate FII activity into two buckets. Firstly, block deals and non-block deals, point one. Point two, FII data also has to be segregated between three different categories of FII. And this was an awakening for us when we stopped using FII for every FII. But FIIs have a different behavior. On the basis of their investing pattern and their behavioral pattern, they can be classified into three. One is those speculative FIIs who buy and sell stocks on the basis of special situations or actively managed funds. That's FII 1. FII 2 are those guys who are investing in index, but for themselves, like retirement funds. There is index fund investing, but it is for themselves. The third is index fund investing on MSCI and FTSE indices, like the vanguards of the world. So who invest in index funds. This is in the chronological order of fluidity of money. The last one is the most stable. So if you look at how the second category is added, the third category is added in the last 1.5 months. I'm so happy that the actual stable money has come in and not the fluid money like those hedge funds and those active managers who come and buy and sell India reasonably frequently.
All right. And there was a lot of conversation, Feroze, that the markets declined on the back of rising COVID cases as of yesterday. But that fear seems to be now abated. Is that something that's likely to impact markets going forward, given that there's been a rise of cases today?
That's a very difficult variable to predict. I personally think that COVID cannot give that kind of corrections anymore. Because you would see the second wave and third wave. Lockdown was not the solution of the third wave. So it will not be the solution for the fifth wave or the fourth wave, whatever wave you might want to call it. So any fall due to COVID rises would be, I would see as a buying opportunity. Because any variable which is already discovered does not permanently dampen the market sentiment.
All right. There's been a lot of conversation on defense stocks, and I'd like to bring your attention to that bucket. Defense stocks, there was a massive rally since 7th of May, nearly to the tune of 39%. There's a lot of profit booking there. So a lot of conversation happening on what's the way forward for defense stocks. What's your view there?
I think, Shweta, re-rating of defense stocks has happened. If you look at last financial year, the Nifty defense index did 23%. The previous financial year, it did 113%. And this financial year, it has done almost about 33% from 1st of April. So if you look at the kind of re-rating defense stocks have gone, and when we dissect it stock by stock, we realize that several defense stocks have lower free float. So they are going to move up sharply and move down sharply. Every high beta sector has a lesser free float relative to the Nifty's free float as a percentage of the total market cap. So point one I'm making is defense is a high beta stock or a sector. That's point one. Point two, if you ask me where its future is, structurally 3, 4, 5 years, I think it can beat Nifty. Nifty defense index can beat Nifty 50 by almost about 6%, 5 to 6% per annum over the next 4, 5 years. Then coming to from a defense stocks, I think ammunition and consumables are going to have a short-term benefit. Platforms are going to have a long-term benefit in the sector space. Depending on your period, you have to be very bottom-up in picking up what stock in the sector we are talking about.
All right, that is as far as defense is concerned. Another group of stocks that continues to be a point in conversation is auto. There's a lot of pressure on India, Feroze, from the US to cut down on duties as far as auto sector is concerned. How's that likely to impact auto going forward?
I think that's a new variable completely, because Indian auto sector, at least the luxury segment, has been protected extremely. You won't believe if I it's so absurd to have a 180% duty on certain set of cars. Now, if I'm looking at the UK agreement, now that might come down in the luxury segment for cars manufactured in the UK from 100% to 10%. So I would stay away from auto for the moment, because I would want to discover what are these agreements which are going to be formed. What is its impact? Because any mathematics can only be derived, and its impact can be derived after we know the mathematical formula of what kind of import duties will be there in the long term. So I am keeping away from auto as an allocation for the very reason that there is an unknown variable, and you would want to wait, and there's nothing big which you will miss out. So the risk reward is in favor.
Are you expecting some sort of significant developments there as far as auto is concerned, given, there's been conversation that perhaps duties will be lowered, but there's no clarity at all coming in there as to what extent, because Donald Trump continues to say India is going to do away with tariff on all of its exports, but that hasn't been confirmed by Indian officials.
Correct, precisely. I think there's a lot of talk. I would definitely want to not jump the gun and try to discover what it is, and then use those to make a fresh projections of what kind of competitive environment they will operate in.
That is as far as auto is concerned. I also want to quickly, take our viewers through the heat map that's on our screens right now. A mixed bag there, Feroze, as you can see. A lot of positive there for the finances sector, for financial sector, banking and finance sector. Kotak Mahindra Bank down by 0.78%, HDFC Bank up almost 0.5%, ICICI Bank up 0.5%. What are you making of banking and financial pack?
I think the worst is over for the banking and the financial services space. And incidentally, it's the largest weighted Nifty. If you have to have any predictive capability on Nifty, the first thing which you'll have to understand is that 31% of that weightage is in banks. And banks have gone through a real trouble over the last few years for a flat yield curve. From June 2022, when the repo rate started going up, you would see that the repo and the 10-year G-Sec almost became a flat rate. And India is not used to a flat yield curve at all. Like I've told Karthik as well, if you go to ask your parents, would they ever do a 5-year FD if the 1-year FD rate and the 5-year FD rate was same? Most of our parents will say, no, never will I do a 5-year, do away with my money for 5 years and 1 year at the same rate. So what was happening is deposit growth was not happening because senior citizens or whoever are the depositors were not lured enough to give away their money for long periods of time. That's what the flat yield curve had on the deposit, and it's very little spoken about. So once the short end of the yield curve and that cycle has commenced, 2 repo rate cuts have happened. There are 2 more possible. You're looking at inflation coming at the lowest numbers of 3.16 in spite of in spite of economy doing well. Direct tax collections last year have gone up by 13.7%. April number of 2.72 lakh crores on GST collection implies that the economy is doing well, but the inflation is going down. That is a very good classic case for the repos to be cut further. So that is going to have a larger impact on the deposit growth and the ease with which you can get long-term deposits and not roll over one-year deposits, which is what the banking system was suffering from. So coming back, net banking is still available at mean P's or probably half sigma lower than the mean and the median P's. So it's one space which gives me confidence that it will bring in stability to Nifty over the next 2-3 years. That's what is going to lead the rally.
All right, Feroze, before I let you go, I have to ask you, Moody's came up with its recent assessment of how tariffs are going to play havoc for emerging market economies, including India. And this obviously comes on the back of India and US trying to finalize a trade deal. Possibly first set of that deal would be announced before July when the reciprocal tariffs kick in. And in the light of the politics around tariffs and trade deals, how do you see Indian markets panning out in short to medium term?
I think both in the short to medium term, India is going to benefit out of the trade war. Okay, and there's enough data to suggest that. Of course, Moody's is right in saying there's going to be havoc in emerging market. That could be very short-lived because we are not so dependent on exports to the US. Point one. Point two. Currently, we have been praying for over a decade now that we will be China plus one. This unsettlement in the global trade order can only benefit India. When all this sedimentation happens, India will be in a better place than what it was. In life, at least in capital markets, you can't ask for short-term benefit and long-term benefit. There could be a short-term detriment, and like we saw, but there'll be bounce backs which will be very, very sharp. So I would not be too worried, and I would see those as buying opportunities, because if you've been praying as a country for years that China plus one hona chahiye, and now this is your stage. Now, will we get to some stage of manufacturing capability to absorb? We don't know. But you're still getting a stage to perform, right? That you were not getting. And that can't be seen as a long-term disadvantage for a country like us. So I personally think that, and one more very important point, why am I not so scared of the trade war? And I don't know whether Moody is factoring in this, is that the trade war could have a different impact on a country like India, because we've already given away 4 lakh crores to FIIs on the pretext of valuation. Valuation के बहाने से 4 lakh crore ले गए हो, तो बेचोगे क्या? Right? Index fund तो बेच नहीं सकते. Right? Index fund is not an India allocation standalone. A fund manager is invested in India because it's a part of the index. Because there is a trade war, India's weightage will not go down in an index. Right? Because indexes are computed on the free float market cap as a relative to the world. So since we have given away 4 lakh crores, if we had not given this away, mind you, this could have given you a 10% circuit down, because all of valuations were high, money had not flown out. So a news power of a news depends on when it came and what happened preceding 6 months. Preceding 6 months to the trade war, we have for almost a year, we've been giving away outflows to all these fluid FIIs who have come for a short-term Indian allocation, non-index fund allocation. So I would not see that. I would see every blip as a buying opportunity. On your show, I've said 22,000 was a screaming buy when most people laughed it out.
Okay, jitna le jana tha le gaye. I think it's only a buying opportunity from here on. Feroze, thank you very much for taking time out for joining us on the show this morning.